All right, good morning, everyone. All right, let's just start off before I go over the review. Let's just go over what's happening from financial news. So, in this update already. Okay. So, first of all, yesterday we did not have any significant financial news. Today we do. Okay, so right now we've got CPI month over month. We've got CPI year over year, and we've got core CPI month over month. So we have two that came in as expected, one that came in better than expected. So I'll go over in a second what the significance of that is. Later in this week, on Wednesday, tomorrow, we have the following: core PPI month over month, core retail sales month over month, Empire State Manufacturing Index, um, PPI month over month, retail sales month over month. Okay, got a whole slew of things there. Then we've got business inventories, NAHB housing market index, crude oil inventories, TIC long term purchases. Right. Then we've got on Thursday, Philly Fed manufacturing, unemployment claims, building permits, housing starts, import prices, natural gas storage. And then on Friday, we've got capacity utilization, industrial production, preliminary U of M, consumer sentiment, and preliminary U of M inflation expectations, and then CB leading index. And then come next week, on Wednesday, the 22nd, we have the FOMC statement, federal funds rate, FOMC press conference, FOMC economic projections. Okay, so the point is this: over the next week and a day, we're going to have a lot of major announcements that are going to affect central bank policy and will affect our economy, the economic outlook. And right now, that's going to be a bigger deal than a lot of other things because of the recent um, bank closures that we've had. So the I guess the thought right now is that all right, well, the Fed's probably not going to want to raise interest rates after that happened because part of the reason apparently, um, well, we know for sure part of the reason for the banks collapsing was interest rates being raised so fast. In case that's not clear, let me just break it down quickly because I noticed there's a lot of misinformation on the internet about this. So here's basically what we know, or well, what we've been told. Now, I don't know everything that happened in SVB, etc. So I'm not saying that there could not be anything else. What I'm saying is, as of this moment, as far as we know, here are the facts. Okay, number one, banks, when you deposit money in a bank, that allows them to loan money, but it's commonly misunderstood that they're taking the money you put into the bank and then they're loaning that out. If they did only that, they would never make enough money. Basically, they have a fractional reserve system, which means that if they have this much on deposit, they can create this much in debt and loans. So the loans are created. That's one of the reasons why the money supply expands because money is created in the act of creating a loan. So the deposits are there. The bank can then loan out money in proportion to, based on the rules, in proportion to the amount of deposits they have. Deposits, they have to have a certain amount in reserve to make sure they can handle any demands for withdrawals. So, in other words, demand deposits, as they're called. The checking account, for example, is a demand deposit vehicle, which means that you can take your money out anytime you want, right? CD would be an example, the opposite, where it's a deposit that you have to leave for a specific amount of time. Anyway, so what a bank will do is they have to pay interest to depositors, like people have CDs, things like that, or savings accounts. So they have to earn enough interest to pay for that. and the interest they pay out can come from either profits they're making off of loans, or if you're in a period where there's not a lot of people taking out loans, or you just can't give them out, or whatever, then they also need to make sure they're still paying interest. So one of the things they'll do is they'll buy treasuries. Treasuries, government debt, guaranteed to pay out at maturity. So as long as they're not buying the government debt at a price point that's higher than the total return, the total amount they're going to get back upon maturity, everything's fine. So the banks, of course, they don't do anything crazy. They basically buy securities, government treasuries at appropriate prices, hold them to expiration to maturity, and then they get back their money. So for the deposits that are not going anywhere or not expected to go anywhere, they basically put some of that money into treasuries. But if interest rates rise very quickly, those treasuries become less valuable. And that's exactly what happened in the case of SVB. You had a large demand of withdrawals of deposits in the amount of, I believe, 25% of the money that was on deposit. And as one person pointed out, there's no bank in existence that we're aware of that could be able to sustain that degree of demand all at once to withdraw funds. So in short, SVB had to sell treasuries. By selling the treasuries, they took a loss because the treasuries were worth less, because as interest rates go up, treasuries that pay lower coupons, lower percentage return, become less attractive. They have to be price adjusted downwards to adjust their yield, the actual percentage gain you're going to make, to match the yield of the newer bonds that pay a higher coupon. I'm not going to get into the whole discussion about that, but that's the reason why when interest rates go up, bond prices go down. So in short, they can't be the only bank out there, or banks out there, the ones that have gone under. They cannot possibly. What was the second one? I keep forgetting that name. What was it? I keep forgetting the name of the other bank. But the point is this: Signature Bank. So the point is this: it's not going to be just two banks. Okay. Now, this whole thing could have been resolved very easily. The easiest way to resolve it is all that had to happen was the FOMC could intervene and say, okay, we'll buy back all the treasuries that you bought at the price that you bought them at, and we'll give you cash in exchange. We'll hold these treasuries for now, and then at some point in the future, we'll try to sell them again, right? Because a lot of the buyers of these treasuries ended up being these banks. You know, the central bank held the treasuries at first. Remember, quantitative easing, they're buying bonds. They create the cash. It goes into the system. You got more cash. Now they're trying to get it back out. So the easiest way to do that is to encourage banks to buy treasuries from the Fed that the Fed bought itself. And therefore, by buying those treasuries from the Fed, the bank exchanges money for treasuries. Money goes back into the FOMC. As of that moment, it essentially doesn't exist anymore until the FOMC decides to create the money again. But here we are. So policies are basically the culprit of all this stuff. And none of those policies have effectively been changed. So as you've noticed, what you're basically seeing currently is everybody running to point to blame at somebody else, right? So now everyone, the current thing that they're trying to do is one thing they tried to do was make it seem like SVB was very irresponsible, which they weren't. They were actually quite conservative in what they were doing compared to most banks. So they can't claim that. Now the next move is, okay, well, you saw President Biden said, well, we're going to hold accountable the people who are responsible for this, the bank people, whatever, which is interesting because basically it's a government person, and, where a government doesn't take responsibility for anything. All the failures, all the problems government people over time have created, they just stay in office. But they're saying that they're going to hold the people responsible. Yeah, sure. So the point is this. Now they're trying to point out a bill that was passed in 2018 as the culprit. It was a bipartisan bill, by the way, but nevertheless, they're trying to spin that too. So it's getting to the point now where it's obvious they don't want to just accept the reality that, yes, you can't suddenly create a ton of money put it into the system and then try to take it out immediately and expect there's not going to be any consequences. Everything we're seeing was exactly what most of us were expecting back when it happened. There were plenty of people who said it, but nevertheless, everyone's now playing, I don't know what you're talking about. It's all the bank's fault. So when the FOMC comes up this time, we're going to have a lot of attention because we don't know how they're going to react now to this situation. If more banks go bust in the near term, which could happen or it may not, we don't know, then we'll see. Now, JP Morgan, the bigger banks, they're going to be fine, most likely, because they always benefit from this situation. It consolidates their holdings every time. So in short, don't expect to see Bank of America, JP Morgan, or anyone like that to go under. But do expect there'll be more pressure on smaller banks like mid-level or smaller. So we may see some more go under. We'll see. But all in all, if interest rates are raised again, that just puts more pressure on the machine, on the system, to maybe push another bank out. Okay, so now we know what the situation is. So that means that between now and then, expect there to be lots of volatility. Do not expect there to be a very congenial, confident market, because the market still has to assess the probability that the Fed will continue. If the Fed continues to raise rates, then that continues to put more pressure on more financial institutions to potentially go under. Obviously, if one goes under, it doesn't go by itself. It has connections. It draws other things in, and we'll see what happens. But in short, the FOMC could have solved the problem right away, essentially what they're supposed to do, but they didn't. So the market has to basically assess what the FOMC is going to decide to do, and that's going to cause more volatility. All right, having said that, hopefully that makes some sense. Having said that, briefly, the stocks that we had looked at on yesterday that were pretty good. I'll just go over some of them quickly. We did have PACW, which was down at first, but since then has risen dramatically. So yesterday we had a sharp spike in the price after it hit a low of $5 a share. PACW then reversed back to 10.32. It pulled back, and as of right this moment, it's currently trading at 14.01. So as of right now, the mood seems to be optimistic. I think the markets are really believing that the FOMC is not going to up rates. So therefore, I think they're expecting that things will be slowed down as a result of this. In other words, they're expecting the FOMC to say, you know what, we were wrong. We went too far, too fast. We'll slow down. That's what they're apparently expecting right now. However, we will have an FOMC member speaking later today after the market closes. That will be at 5:20 Eastern. So if they don't suggest anything, that if they don't suggest that the Fed's going to change its mind, then come tomorrow, probably a lot of these gains will be erased. So far, if you look at the banks that have been hit the hardest recently, probably they're going to be the ones that are most likely to rally, or at least they're rallying so far. So PACW will be on the radar for today. Again. All right, another stock that did fairly well, Western Alliance, which is also, I believe, a bank. Yep. Wrong one. Wrong one. Looking at the wrong list. Hold on. Sorry, I forgot. This didn't change my list. Wrong bank. All right, so Mara looks like it's moving up as well. Marathon Digital, so we'll put that on the radar. It did move well yesterday. Novavax was a good performer yesterday, but doesn't look like it's going to be today. TCOM was a decent performer yesterday. Doesn't look like it's going to do much today, but hopefully some of you caught that. PAAS, it did perform well in the morning, but it didn't go anywhere after that. So although this one was decent in the morning, after that it kind of went sideways. So it doesn't look like much is happening with that this morning. see, SARC, SGEN, neither of those panned out well. All right, now as far as right this moment, second here. As far as right now, pre-market, let's just see what we've got. All right, I already mentioned PACW. I already mentioned Mara. Looks like Riot Blockchain, RIOT, is active. So we'll add that to our radar as well. It's not over 1 million shares, but it probably will be. So I'll take the leap that it will. Looks like Coinbase is active, but I think this is just general market movement for Coinbase. So no need to watch it in particular. Looks like AIMD is up today, pre-market. 3.9 million shares, up 72%. So we will add that to our radar. Probably will be a pump and dump, just to be clear about it. Most likely the stock AIMD will be a pump and dump, but we'll find out. Meaning that most likely when the bell rings, it's going to sell off. Looks like GTLB is down sharply. GitLab is currently down 32%, under 1 million shares. It's coming off of earnings. I'm not going to watch it today since I'm sure we're going to have plenty of other things to watch, but just making a mention of it. The stock symbol MNTV is being bought out for $1.5 billion. So no need to watch that one. But MNTV, Momentive, is being bought out. So this one, since it's a takeover, no need to watch it. All right, XPEV, no. That's not a NASDAQ stock. Let's see, SoFi. SoFi might be worth looking at. Let's see. Yeah. SoFi doesn't look that impressive. It just looks like it's doing what the rest of the market's doing. So I'll skip that. Now Charles Schwab did have a bad day yesterday, and now it's recovering. A CHW. So oh, sorry, that's a New York Stock Exchange stock. Never mind. Forget that one. Lyft, no. Actually, Lyft looks a little stronger than it should. Only 500,000 shares. Okay, never mind. Bed Bath and Beyond. All right, so that looks like it for the pre-market movers. There could be other stocks that I didn't notice, but those are the ones that are standing out right now. Now, again, remember that we're probably going to get a very volatile next few days, especially going into next Wednesday's FOMC meeting. So do not expect this to be a very mild-mannered market. We're going to have to expect a lot of range of movement. So just bear that in mind and should be okay. All right. So other than that, folks, so we have PACW, MARA, RIOT, and AIMD. Those are our 4 for today. So we'll watch those at the open. All right. So I'm going to wrap up here so I can get the coaching rooms started. Anyone who's happening to watch this broadcast who is not a member of our services, be sure to check out fundertrading.com, our website, learn more about how we fund traders, and we'll go from there. All right. Take care, folks.